The Nasdaq just hit another all-time high. China's Chi-Next Growth Index did the same. Well, the engine behind both moves is AI. But there is one sector that is directly wired into the AI trade, operates some of the most sophisticated technology platforms on Earth, and is still sitting at roughly half its all-time high. To get back to where it once was, it would need to double from here. That sector is China's internet stocks. And yesterday, two of its biggest names, Alibaba and Tencent, reported earnings on the same day. Both showed the same thing. AI is no longer a promise on a slide deck. It is showing up in revenue and margins right now. So is this a value trap or the most overlooked entry point in the market this year? That is what we are working through today. My name is Phoebe, and you're watching Trading Key. Why Alibaba Cloud's growth rate keeps going up. Let's start with Alibaba. The single most important number in this quarter's report is the Alibaba Cloud growth rate, because the direction of travel is impossible to ignore. Alibaba Cloud brought in $5.73 billion in revenue this quarter, up 38% year over year. To understand why that number matters, look at the 4 quarters before it. Growth came in at 18%, then 26%, then 34%, then 36%. This is not a company maintaining a growth rate. It is a company accelerating one, and each quarter the acceleration gets larger. Revenue from external customers, meaning businesses actually paying for cloud and AI products on the open market, grew 40% year over year. Margin expansion is happening at the same time, which is the combination every investor wants to see. Alibaba Cloud's adjusted EBITDA profit hit $522 million, up 57% year over year. The adjusted EBITDA margin came in at around 9.1%, up 1.1 percentage points from the same quarter last year. What that margin expansion tells you is that Alibaba Cloud is no longer competing primarily on price. Just 1 year ago, Chinese cloud providers were cutting rates aggressively to win enterprise accounts. What improving margins signal is that Alibaba's standardized AI and cloud products are now good enough that customers are paying list price without demanding heavy customization or discounting. Here is how to think about that shift. A cloud provider doing heavy custom work is like a tailor cutting bespoke suits. Every engagement starts from scratch, margins are thin, and the only way to grow is to hire more tailors. A cloud provider selling standardized products that customers want as is builds the product once and sells it to thousands of companies. The cost gets spread across an enormous customer base, and the margin on each additional sale compounds upward. That is what is happening at Alibaba Cloud, and the margin data is the proof. The AI specifics inside the earnings are striking. Alibaba disclosed that AI-related products now account for 30% of Alibaba Cloud's external revenue. AI revenue has posted triple-digit year-over-year growth for 11 consecutive quarters. The number of customers using Alibaba's Model Studio AI development platform grew 8 times year over year. Management also said Alibaba's full-stack AI investment, covering models, cloud infrastructure, and applications, has moved from what they called early incubation into scaled commercial monetization. They guided that AI-related revenue is on pace to exceed 50% of cloud external revenue within roughly a year. And the company flagged that its AI capital expenditure over the next 3 years may exceed the $52 billion plan it had previously disclosed. Too long didn't read, Alibaba Cloud is accelerating on both revenue and margin. The AI money is real, and the growth rate is still going up. Tencent is running the same AI ad playbook that worked for Meta. Now, Tencent's AI story plays out differently from Alibaba's. The clearest readout of AI at Tencent is not in cloud revenue, it is in advertising. Tencent's marketing services revenue hit $5.25 billion this quarter, up 20% year over year. That might look like the same pace as the prior year, but context changes the read. The Lunar New Year fell later in 2026, which pushed the seasonal ad market slowdown further into Q1. Growing 20% through a longer than usual soft period means the underlying momentum is actually stronger than the headline number suggests. Tencent's explanation for the growth tracks closely with what drove Meta's advertising acceleration, and it is worth understanding the mechanics because they are the same in both cases. The growth came from upgraded AI-powered ad recommendation models and the expansion of closed-loop marketing inside the WeChat ecosystem, which improved ad performance and let Tencent charge more per impression. Meanwhile, Meta grew ad revenue 33% in Q1 this year. For context, Meta's ad growth rates over the prior 3 years were 16%, 22%, and 22%. AI made the ads smarter, which made them more effective, which let Meta charge more per ad slot. Tencent is running the same playbook inside the world's largest messaging ecosystem. The mechanics work in 3 layers. First, better AI targeting means the right ad reaches the right person more often. Second, that improved targeting lifts conversion rates, meaning more people who see an ad actually take action. Third, higher conversion rates let the platform charge more per 1,000 ad impressions, which is the eCPM metric. All 3 layers compound into revenue growth and margin expansion simultaneously, and the effect gets stronger as the AI model improves over time. 2 data points from the report confirm this is operating at scale rather than in a test phase. First, Tencent's automated ad placement product, called AIM Plus, now accounts for about 30% of total advertiser spend on the platform. Second, after Tencent expanded its video feed recommendation algorithm, total time spent on that feed grew more than 20% year over year. More watch time means more ad inventory. Better targeting means higher prices for that inventory. The one area where Tencent lagged Alibaba is cloud. Tencent reports its cloud business inside a broader enterprise services segment, so a direct cloud revenue comparison is difficult. Enterprise services overall grew 20%. Tencent was candid on the earnings call about why cloud is not growing faster. GPU compute capacity is constrained, and available resources are being prioritized for internal AI projects over external cloud customers. Though this bottleneck may resolve faster than expected. Reuters has reported that since the release of DeepSeek 5.4, compatibility between Chinese AI models and domestic chips has accelerated significantly. DeepSeek 5.4 has been validated on Huawei's Ascend AI chips, and Huawei confirmed its latest cluster architecture fully supports the model. Reuters also cited sources saying Tencent, ByteDance, and Alibaba are all actively acquiring Huawei's latest Ascend chip. Once domestic compute supply scales up, the constraint on Tencent's external cloud business should ease considerably. Gaming revenue is being understated, and food delivery losses are stopping. Let's look at the non-AI businesses, because both companies showed meaningful improvement in areas that have been weighing on their stock prices. On Tencent's gaming business, domestic game revenue came in at $6.24 billion, up 6% year over year. International gaming hit $2.59 billion, up 13%. The 6% domestic number looks modest, but Tencent flagged something important. Because the Lunar New Year fell later this year, a portion of player spending that would normally register in Q1 was deferred for revenue recognition purposes. The actual player spending, which is the real-time cash flowing in from in-app purchases, grew by double digits year over year, well above the reported figure. This is how game accounting works. When a player buys in-game content, that revenue is not always recognized immediately. It gets amortized across the period the player is expected to use the content, which can run several months. The Q1 reported number is understated because of the calendar shift. The implication is that Q2's reported gaming revenue will benefit as that deferred cash flows through the income statement. On Alibaba's food delivery and quick commerce business, this has been the single biggest drag on Alibaba's overall profitability, and the market has punished the stock for it. Alibaba's China e-commerce segment posted an adjusted EBITDA of $3.3 billion, down 40% year over year. At the group level, the compression was even more severe, down 84%, leaving non-GAAP net profit at roughly $11.8 million for the entire quarter. That is why institutional investors have avoided the stock despite the cloud growth. The losses from competing in food delivery have been overwhelming the overall profit picture. But this quarter delivered the most important signal yet that the bleeding is stopping. For the first time, management disclosed that the unit economics of their instant retail business are improving and that average order values are rising. Management said they are highly confident in achieving unit economics break-even in instant retail before March 2027. Unit economics is worth explaining precisely because it changes what this disclosure means. Unit economics isolates the profit or loss on a single transaction before shared overhead like corporate salaries or headquarters costs. In food delivery, the calculation is take the commission and delivery fee from one order, subtract the courier payment and any promotional subsidy, and see if the result is positive. If unit economics are negative, the business loses money on every order and growth makes things worse. If unit economics turn positive, the business makes money on each marginal order, and enough orders eventually cover the fixed overhead. US investors who followed the DoorDash and Uber Eats price wars will recognize this pattern. The question was always the same: can these businesses ever make money per delivery before you account for corporate costs? DoorDash's eventual unit economics turn was the catalyst for its stock re-rating. Alibaba is now signaling the same inflection is coming. Once each delivery is profitable at the transaction level, the path to overall profitability becomes arithmetic rather than speculative. How to think about China's internet stocks after these earnings. Okay, let's pull all of this together. Alibaba Cloud is accelerating on both revenue and margin, with AI already at 30% of external revenue and set to cross 50% within a year. Tencent's advertising business is growing 20% through a seasonally weak period, powered by the same AI ad model improvements that have driven Meta to 33% growth. Tencent Gaming is understating its real momentum due to accounting timing. And Alibaba's food delivery losses appear to be reaching a structural inflection point. Here is the bigger picture framing for US retail investors. The Nasdaq and Chi Next are at record highs. Capital that has made money in those markets is looking for the next place to deploy. China's internet stocks, which US investors can access through the KWEB ETF, are trading at roughly half their all-time highs, while the underlying businesses are showing fundamental improvement. AI is no longer something these companies are promising for the future. It is showing up in quarterly revenue and margin numbers right now. That combination of depressed relative price and improving fundamentals is the setup. The question is whether the valuation gap closes gradually as earnings continue improving, or whether capital rotating out of stretched US and Chinese growth indices acts as an additional catalyst. This is not content we cover often on Trading Key, given our usual focus on US-listed stocks. But when two of the largest technology companies in the world report earnings on the same day and show this degree of synchronized AI monetization progress, it is worth examining carefully. So, where do you stand? Are you watching KWEB or any Chinese internet names right now, or are you staying focused on US-listed names? Let me know in the comments below. Thanks for joining me today. If you found this video helpful, remember to subscribe to Trading Key, give this video a like, and share it with a friend who might just benefit from learning this too. With that, I'll see you in the next one.